Hi everyone, this is Kerem Baram with Solar Academy. I have John Bonanno with me. John, what are we going to share with our audience this week?
Well, today we're going to talk about opportunity zone finance, which is a federally tax-advantaged capital source that entrepreneurs can use in their corporate equity investing or their project equity investing. And both are advantageous for the offerer because you know that the investing party has advantages beyond what your equity will give them. This is all about the basics of opportunity zone transactions, which are really unique. So this chapter that we're going to view in a minute, it steps you through the process of how you need to transact, because there are some very unique features of the transaction, and all of them are mandatory to be in compliance. It's not very difficult, but it is very specific. In addition to opportunity zone federal tax benefits, there's obviously the ITC as well that applies to solar. This is similar. ITC is focused on passive income, and opportunity zone tax advantage is focused on benefiting a capital gain for the investor. So they're different tools, and you can use them together on the same equity offering. In addition to that, there's something called ESIC that's coming up at the federal level, which is being proposed by two senators, Crapo and West and Whitehouse. And that could be a very interesting tax benefit coming up. But today you should learn about opportunity zone tax advantaged investor dollars that can benefit your equity offering.
Great, thank you so much.
Okay, hi everybody. Thank you so much for taking time out of your day today to join us, where John Bonanno, our CXO here at New Energy Nexus, is going to talk to us about opportunity zones. And I will let John take it away from here.
Thank you, Joy. And also hello to Sarah Chester, who is also with us, but invisible at the moment. I think that CalSeed and this team is, like, bar none, the best. Really proud to be part of this great team. And now,
thank you, John. Hi, all.
Let's see your little face. There she is. See? There you go. All right. Thanks for joining us, everyone. The topic for today is opportunity zone tax incentive. It's a tool that has been very widely publicized by certain parties. And I think there's some misinformation out there, which we'd like to dispel, and we'd like to give you the best information we have at the moment around this subject. Part of our work at New Energy Nexus is, of course, to help you launch your businesses and then to fund your businesses, which all of you have experienced in some level. But it's also to cultivate you as an executive and your team to increase your ability to solve the challenge that you're looking to solve around the climate crisis, and then scale that business to be meaningful in terms of the impact around the world or locally, however it may be. So today's session is about opportunity zone tax. And just a quick little background, New Energy Nexus is the manager of the California Clean Energy Fund, but also is around the world and across the nation. And we really have grown a lot in the last year and a half, 2 years, and we continue to seek a very specific mission around supporting diverse entrepreneurs to drive innovation and build equity into the global clean energy economy. And our vision is nothing short of 100% clean economy for 100% of the people. We believe that this is a very critical moment for bringing together a diverse crew of entrepreneurs to equitably solve the transition to a non-carbon economy. So a little bit of I am neither a lawyer nor an accountant, and all that other mishmash in there from our amazing friends at DLA Piper. Our mission is really help you launch, fund, and cultivate your business while you scale it. Okay, so I am the CXO of the New Energy Nexus, which Joy had said before. I've been an entrepreneur in the clean economy for a decade and a half, which leaves lots of welts on my body. I've also been an investor, a board director, and an operator of a variety of businesses. We're supported in this work around Opportunity Zone tax by some really amazing partners. Craig Teague from DLA Piper, he has just been critical in helping us create these standardized contracts for the various parties to contract around this type of transaction. Orla O'Connor is the National Opportunity Zone lead at KPMG, probably a group you've heard of, just like DLA Piper. Her background is worked at the IRS, Goldman Sachs, and Carlyle Group, and then Greg Rosen, who is a prolific clean economy entrepreneur. Structured finance is really his bailiwick, but he's also been involved in growing businesses like PowerHive and Mosaic. So we're not alone here. We work with partners on creating what we believe is the best education around investing, clean economy investing in opportunity zones. And designated opportunity zones, as you'll find out, are areas of the United States that are considered low income.
Can I jump in really quick?
Please.
Sorry, I just want to say that the slide that you saw was really like an organizational overview of the people who are in EZOZ, which is an organization kind of under the New Energy Nexus umbrella. Just wanted to kind of clarify for everyone.
Yeah, they're really contributing partners. They're not actually in the program. They're really just contributing partners. So,
right. For EZOZ, not necessarily New Energy Nexus or CalSeed.
That's right. That's right. That's right. And they just merit calling out because of their contributions and our knowledge that we share with everyone. And so I think it's appropriate to just call them out and say thank you to them. In our work around opportunity zones, there are three distinct parties that become stakeholders in a transaction that you all as CEOs of clean economy companies should be familiar with. There is the party that has had some sort of liquidity event where they are a capital gains beneficiary that the federal government seeks to tax. And so this is a tool that they can use with that capital gain to be more efficient, and they can invest in a corporate that is compliant or qualified, or they can invest in a project. So if you're doing a first project, of your new technology, it's possible to get an equity investor in that project company, or you can offer a new slice of corporate equity to these investors, and that can also be a qualified transaction. The second stakeholder group that we work with is you all, CEOs of clean economy companies looking to do a regular old Regulation D, SEC compliant, like your Series Seed or Series A financing. These investments must be equity. They cannot be debt. So just to be clear about that, a convertible note is not an acceptable way to use these capital gains, nor is providing debt to your organization. It must be a priced equity round that is compliant. And then also we've been working a lot with project developers, people that are building solar arrays, wind farms, hydroelectric facilities, on how they can use and benefit from this tax incentive. All right. Okay, so let's talk about a little bit of history of this federal tax incentive. And I'm saying federal specifically because this is a federal tax law, and it does not necessarily mean that your state tax regime is going to be in line or compliant with the federal law. So for example, the state of California is not in conformity with the federal law. So if someone who is a California taxpayer has a capital gain event the benefits that I'm going to describe to them would only be applicable to their federal liability. They would have to pay their state liability in year one. So just to be aware of that. Now, some states are in conformity fully, so everything that would apply to the federal tax benefit would also apply to their local tax payment as well for their capital gains. So how did this all come about? The idea was initially germinated under the Obama administration, and three gentlemen. One is Sean Parker, who is quite famous for being the first president of Facebook, but also a gentleman by the name of Steve Glickman and John Letizeri. They all came together under a lobbying group called EIG, the Economic Innovation Group. And they're based out of Washington, D.C., and they worked with the Obama administration to cultivate this idea around how can we help bring together or bring equitable long-term transactions to low-income America, because over the last 3 decades, capital investment in low-income areas has been anemic, and it's really causing some extraordinary gaps between wealthy and poor. And so to try to counterbalance that, this idea was created. It went through a bipartisan process championed by Senator Booker from New Jersey, quite famously, and Senator Scott from North Carolina. And it had bipartisan support, and it was passed in the Tax Cuts and Jobs Act of 2017, in which opportunity zones were created. And this is a place-based tax incentive, much like new market tax credits or others. There are a lot of differences between past place-based tax incentives, and I'd be happy to go into those if it's of interest to anyone. But for this moment, let's just pass over that and discuss where these locations are. The locations are frankly everywhere: in urban centers, transitional areas, landfills, rural, urban, island communities. It's really everywhere in the contiguous and territorial United States. So, for example, there are 8,761 designated locations throughout the United States, and you can find that map on easyoz.org. But you can also find that map if you query Google and say, opportunity zone map or something like this. It includes all of the island of Puerto Rico, and that becomes important because Puerto Rico, for example, is rebuilding after Superstorm Maria, and they're rebuilding almost everything. So street lamps, solar generation, storage, all of their municipal infrastructure is being rebuilt, and a lot of opportunity zone dollars are going to Puerto Rico right now because of that designation and such a large footprint. So there are some requirements on timing, which we'll discuss, but when they were initially released in 2017, you might ask yourself, why has it taken so long for this to materialize? And if you look back at something like the investor tax credit or the production tax credit for wind and solar, you'll see that there was a ramping up period where people were not sure about how the tax would be used, how they would treat certain activity within the transaction. And so capital waited a fair bit of time before they came in earnest. And this is what we're seeing as well with the opportunity zone tax incentive. There were some clarifications required because certain treatments were not clear in the original 2017 legislation. And so the federal treasury had to go back and do 2 clarifying moments. The first was in April of last year, and the other was in December of last year. With both of those, most experts in the field, including our friends at KPMG, feel like the ambiguity is out of most of the corners of this tax. And so now we're seeing a significant capital flow into the marketplace to make these long-term investments in low-income America, in businesses and in projects. There is no limit to the size of the investment, and in aggregate or in individual investments. And these areas have been designated by the federal government and remain in in legislative qualification for 10 years following the designation. So how does the basic transaction work? And I apologize in terms of mechanics. If there are any questions, Joy is monitoring the question box, so the chat box. Feel free to go ahead and drop a question as we're moving along into that box, and then she'll call it out in an interactive way. We don't have to wait until the end. We can hit the questions as we go through them. So how does it work in the mechanics of it? So the party that has the tax deferral or seeks a tax deferral could be an individual, it could be a partnership, it could be a corporate, it could be a foreign individual, or it could be a foreign corporate or partnership. So anyone with a federal US tax liability can take advantage of this tax benefit. So the party that has the tax liability can defer that liability within 180 days of their liquidity date. They can move the money that they would like to have tax deferral on into something called a qualified opportunity zone fund. And then within 180 days of the deployment of that capital into the fund needs to deploy that money into a qualified business or business property. So the mechanics of the deal require a qualified opportunity zone fund to be set up and available to the tax investor, okay? So what are acceptable or qualified businesses? You have 4 different types of businesses that are qualified. The one that has gotten the most press, and probably what you've heard a lot about, is in real estate. We're not focused at all on educating you on real estate. If you have interest in that, you'll have to seek other information sources. What we're doing here is we're trying to help you get smart as the CEO of your business, how you can use this tax benefit to your advantage. So if you're opening a new business, which all of you have established businesses, so that wouldn't be you, or if you're expanding your business and you are willing to move into an opportunity zone, you could do that and become qualified. Or you could, by the nature of your current location, be qualified in an opportunity zone, which of course is pretty nice because you don't really have to go anywhere or do anything to take advantage of this. Anytime you're doing an offering for an opportunity zone investor, a new equity class has to be created. And in most cases, the companies that are here are in a situation where they're doing either their Series Seed or their Series A. So just be aware that it has to be a new share class issuance, and it can't be something that is a heritage type of offering. And in most cases, because of the situation you all are in, or I should say the phase of growth you're in, this is not going to be a challenge. Okay. So just to be aware, this tax benefit is all going to the investor. And so you as the CEO, your job is to be knowledgeable that this tax benefit exists, and also that you are a compliant business, and that if an investor is utilizing these tools, you should recognize the value that you're getting in order to prudently negotiate and respectively negotiate with that counterparty, and honestly request some of that value for yourself. Now we'll go into your role next, but I just want to speak right now to the benefits to the investor itself. So they have their capital gain event. They put it into a qualified opportunity zone fund. The fund then directs the dollars into your business. They now can have an up to 10% exclusion of their original tax liability. So if they had $1 million of capital gains, in 5 years' time, they can take $100,000 off the table tax-free. That's quite a nice benefit. They also are able to defer their tax liability for 7 full years. So if they do this compliant process and invest in your business, they don't owe the federal government in the first year as they normally would. They now can wait to pay that. So the time value of money says that this person's 100% of their money without any tax being taken out is going to create value for them over 7 years. That's a real benefit to them, okay? And then at the conclusion of 10 years, any liquidated assets after 10 years can be taken out by the investor tax-free. So that's a very big one that you should all as CEOs take note of, because if the investor is making an investment in your business at, let's say it's a $5 million pre-money valuation today, and you go out 11 years time, crushing your business, doing a great job, and you sell that business for $100 million, that investor can liquidate their position without any tax on the capital gains of that liquidation. So that's truly an enormous benefit to the investor. I saw that there was a flash, and I didn't. Joy, is there a question, or I saw a flash on the screen? I don't know if that was a question or not.
Yeah. So a question from Mark. This tax benefit is only if your business is located in the opportunity zone? Correct.
Or if you want to move your business into the opportunity zone. And Mark, I would certainly encourage you to take a look at the map. You'd be surprised that you may already be in an opportunity zone. And as with the growth area of most of the companies that are listening today, many of you are small single person shops or 2-3 people working in a WeWork space. WeWork has, or any other shared office location, many of these networks have locations that are in opportunity zones. And so for you to make this change to be a compliant business is really not a lot to ask. So I would say, number one, Mark, check your current location, whether you are compliant or not. And secondly, if you're planning to grow and move anyways, you should consider an opportunity zone location exclusively to give yourself options as the CEO. Whether you use it or not doesn't matter as much as giving yourself the options to use it. Does that help, Mark?
There's another question in the chat.
Okay.
From Dover. Does this have to be a physical product, or where the product is located, or where the work is taking place by the company location?
It's the corporate headquarters. It's where the management sits. So it's not the registered address. I'm sure many of you are either Nevada or Delaware LLCs or S Corps. It is literally where your headquarters sits. So there is a test around that. It's called a regionality test. But and we can go into that at some length, but rather than get stuck on that here, it really comes down to what is the intent of the law. The law is intended to build businesses and projects in low-income America. So they don't want you to take a post box in a low-income area and then have all your team in a high-income area growing and creating economic value and training people locally and things like that. The intent is to create value in low-income America. So we feel, and we're very conservative on this, but we feel that the best advice is to truly try to follow the letter of the law and the spirit of the law, if that's helpful, Dover. And we can take that offline as well if you'd like.
There's a couple more questions.
Okay.
So from Jean is asking, is there a spreadsheet that we can quantify the investor savings based on the investment value from the 10% capital gains tax write-off and deferral savings, et cetera?
So Jean, it's a good question. It's impossible to calculate the value of the tax benefit because this really is how the capital gain investors' capital gain is characterized. So it could be a day trader that has a very high tax liability with the federal government of up to 37%, or it could be a long hold situation where someone's selling an old family business where they have a very low basis, but they've owned it for more than a year. And so it really depends on their current income as to what the federal tax is on capital gains. So I would suggest that you don't try and figure out what the actual value is to this counterparty. I would simply say, where do you expect your business to be in 10 years' time? And if someone was to make an investment in your business today and then liquidate that position after 10 years without any tax, what is that benefit? Now, I wouldn't get greedy because it's theirs to give you, But you certainly, as we'll see in the next slide, and maybe a good transition, like, what do you get out of this? Well, you could get a lower cost of capital, right? So if you're arguing with your capital source counterparty that your Series seed round should be at a $5 million pre-money valuation, but if you know they're using tax advantage dollars through this opportunity zone mechanism, you might say, hey, can you take your boot off my neck? Let's agree that it's 7 million, because if you liquidate this after 10 years with zero capital gains, that's a pretty big benefit to you. Can't we share some of that value? After all, I'm creating the value here, right? So I think that's the conversation to have, but I think you must always, as the CEO, be respectful that it is their value to share with you. It's not a right that you have. So just be very careful as to not overplaying your hand, Gene. Does that make sense? Okay.
There's another question from Dick Flask. Can we set up a separate C Corp subsidiary to take advantage of this?
Again, we're very conservative. I think that a lot of parties would love to take a lot of your money in service fees to help you work out a very complex strategy around this. And they're doing it all day long. I would suggest simplicity is the winner here, Dick. I would suggest that if you are currently in a location, and I don't know where your headquarters happens to be at the moment, but I would query that location and see if you are in an opportunity zone. And if you are, then fantastic. And if you're not, then you may consider moving half a block down the street to become a qualified business. Or you may say, listen, I'm not ready to make this move. And so then I'm going to have to just forego using this financial tool. That's okay too. I would suggest, as a condition for the investment, if you were considering moving, I would definitely consider being in place prior to taking any capital. So don't say, oh, we're going to move, I swear it, and then you take the investor's money, you're not a compliant business, and then you say, we're going to not move. That, even if you had your best intent to move, I think you're just going to get yourself and your investors in a whole lot of trouble doing that. You should really make the move, then take the capital. Dick, is that helpful? As an explanation. I know it may not help you because I don't know if you are or not in the opportunity zone, but does it answer your question?
Yes, more or less. If we were to set up a subsidiary, it would be initially in an opportunity zone period before we sought any funding for it. It's just that I'm not sure that I want to use my company as it is as the investment vehicle for a manufacturing operation.
Well, okay, so you and I should talk about that more, but at the state of your business, which is a very small size, the more simple you can make it for the investor, the more attractive it is. If there's any sort of encumbrance of other businesses or sharing of balance sheets in any way, it just makes it really complicated. And I would definitely not do a subsidiary because it will feel very disingenuous. And I'm not sure that an investor would see the value in a subsidiary. So they really want to be, at least my experience is equity investors will do the same amount of diligence on whether the underlying equity merits investment or not, and whether it's complicated or not, or whether it's a good market opportunity or not. And then if they can also take advantage of the capital gains benefit, then that's just icing on the cake. The underlying deal needs to make sense for someone to make the investment. The tax will not wag the dog here.
Yeah, we're not suggesting tax wag the dog. We want to set up the operation in an opportunity in the Central Valley, which has a lot of opportunity zones, but that has nothing to do with tax advantages. But if we were to set up an operation in the Central Valley, it would be a lot cleaner, I think, all the way around, and a lot simpler for investors if it were a standalone C Corp that was set up to do that.
Yeah, why don't we take that offline, Dick?
Okay.
Joy, were there some other questions there, or should I carry on?
Real quick, one came up from Mark. So in theory, a separate HQ office could be set up in the OZ where the manufacturing facility is not in the OZ.
Yeah, that's possible. I mean, it has to do with some asset allocations, but yes, and I would say, Mark, we should talk about that more. In fact, one of our portfolio companies is considering doing just that, where the value of the manufacturing facility is really not material to the value of the enterprise, and the enterprise HQ is in an opportunity zone and thus makes a qualified and compliant investment. But the HQ is in the opportunity zone, and the point is the point. So let me carry on a bit, which is what's in it for you, the CEO, lower cost of capital, potentially better investment terms, and it does expand your potential capital partners landscape. So just to give you an idea, everyone, in almost all cases, the traditional venture fund is a general partner, limited partner structure. That's all post-tax money. That means someone has taken their money and said, oh, I believe this manager of this venture fund is smart, and I want to put my $5 million into that fund. So that's all post-tax money. So traditional GP/LP structured fund, general partner, limited partner structured funds, which is most venture funds, don't have any interest in this opportunity zone tax tool because they can't use it. So who has more interest in this are private individuals that are high net worth, and also family offices have a lot of interest in this. And traditionally, they have not been the big players in the capital markets for the clean economy. And we're seeing a return of those parties to the clean economy because of this capital gain benefit, which is quite exciting. So I think the pool of potential capital sources is expanded by this tax benefit being available to you. Okay, so who else wins in this transaction? Certainly the community in which you're going to build your business will win because you're going to be eating more lunches, using more dry cleaning, buying more coffee, potentially training local people and creating local jobs in those communities. This is truly the intent of the law, is to have a positive economic impact on these low-income communities, whether transitional, rural, urban, etc. So there's a three-way win here. The investor wins, the CEO wins, I would say the enterprise wins, clean economy enterprise, and the community in which you're going to build this business wins. So how does the capital source start? I'm not going to really go into this because it doesn't really have material impact on you all. This is more the nuts and bolts of how they transact. But rather, let's focus on you all. I mentioned it before, but honestly, you can go to Google and just query opportunity zone mapping tool or something like this, and you can find a good map for where the zones are. We also have a mapping tool available at easyoz.org. And I would, as I suggested before, go look in that map and identify, is your current business in a location or not? And if you are, great, you should use the tool. If you're not, you may want to consider moving into a zone to be compliant. And then you need to be educated on the mechanics. We have a site which has some explainer videos on it, which is easyoz.org. And I would encourage you to go and just watch those videos. There's no cost to you. There's a lot of information out there, KPMG, DLA Piper. There's a lot of information out there on this. So please use all of those resources and get smart and figure out what your play on it is. And be prepared to respectfully request some value sharing with your investors that are going to use this tool, because you recognize the value that they're going to potentially get out of the deal. You're creating the value. So why wouldn't you request some respectful sharing of that value? So also there are other roles to play, like the state and the county and the city. They can all get involved in how they could be helpful in these transactions. This is really not material for this conversation, but lets you know that we're working with all these stakeholders, and you should recognize that that they should be considering hiring grants or new job creation grants and things like that in these designated areas. So that's what I had for this part of it. Joy, did we have more questions, or were there things that people wanted to focus in on a little bit more?
Just got a couple questions. Sergey is asking, would an additional investment from existing shareholders of the company qualify for these tax benefits?
Well, the investor would have had to use a qualified opportunity zone fund. So they could do a new investment through an opportunity zone fund, which would then, of course, give those benefits to the investor, and of course, give Sergey the opportunity to discuss value sharing with that particular capital source. So the answer is, if the investment has already been made, no. If it's a going forward investment, yes.
And then another question from Philip. Please give an example of how the OZ can be part of project finance.
Good question. Solar or wind or hydro? What's the asset class that is being considered?
It's solar thermal.
Solar thermal. Okay. So how it works is, I mean, as you know, there's a project company that's set up, typically an LLC. And if the project is big enough, you can consider, as the developer, putting some debt on it. But then there's also an equity contribution, which obviously pays for the capital equipment cost of the project. And so you can use some portion or all of that equity portion of the capital stack to fund it with outside investors. And if the project location is compliant, and this is a new build, it's almost impossible to argue that it's not qualified, because it's all additional and it's completely regional. So we have tried, I don't know if you're working on commercial industrial scale or utility scale. That would also be helpful to understand, because if you're going to have an ITC investor with a depreciation investor, it gets far more complicated. But let's just call it straight line and use a hydro example. Oh, here we go. We have a response.
Industrial ITC is part.
Okay, so there is an ITC component. Okay, so what we found in the solar, specifically with ITC involvement, is that the terms in which the ITC investors are requiring are quite challenging to opportunity zone capital, because they're, in many cases, they're requiring 100% of indemnification, which is tough for a capital source to swallow. So they're getting a yield which is much smaller, and they're having to indemnify 100%. Now that's a nuance, and I don't want to go into that because it's sort of a more complicated conversation, and we should take that offline. Please contact me about this. We tried all of 2019 to get opportunity zone investors investing in the sponsor position of projects. And because the ITC investors were so difficult to work with, and because the current equity investors in solar projects have such a low yield rate, that the combination of very low yield and very onerous terms deflected most of the investors away from doing solar project investing in the United States. And we looked at over 400 projects with parties that had many hundreds of millions of capital gains to invest. And we only executed one project in 2019 in a solar project. And the only way we made that work was because in that very specific case, the ITC investor was the OZ investor as well. So they used their passive income on one side of the balance sheet, and they used their capital gains on the other side of the balance sheet, and they invested the entire block of the sponsor equity, and they took all those benefits to themselves. Now, I know that's a very unique example, and that's why we only transacted on one project in 2019 after looking at over 400. Does that help answer the question? I think it was Mark.
It was Philip.
Oh, Philip, I'm sorry.
He will follow up with you.
Good.
So we have a few more minutes. If you have any questions, feel free to enter them into the chat. You can also unmute yourself and ask the question. I guess this is also a good opportunity to plug the open office that John has recently offered to all of our CalC companies. So if you have questions about this or other things, you can reach out to John also.
And I mean, to summarize, I think that the reason why we think this is an important tool is that it gives you as the CEO potentially more flexible capital to fuel your business. And it's very difficult to fund clean economy businesses that don't have a customer, that don't have revenue, that don't have patents granted. This is the most challenging place in the growth trajectory. So I would suggest that you have all your options available to you. And because of your small size and potentially your nimble nature, you may want to consider moving into a location to be compliant. If it's just simply moving from one WeWork space to another one, you may consider doing that to give yourself options. And how you would present yourself to capital sources is that you are a compliant opportunity zone business. And that's going to elicit one of two responses. It's going to indicate to the counterparty, oh, this is a sophisticated operator. I like that. Tell me more about your business. Okay. Or secondly, they're going to say, what is that? And in that case, you have a chance to educate your capital source and then to have the first effect, which is you impress them with your knowledge. So it is completely a very low cost way to benefit you and your business.
That was a great conclusion. I'm not seeing or hearing any more questions. So on that note, I think we can end the webinar, and then you have my contact information. You should have John's contact information. If you have any questions about this, please feel free to reach out. And with that, I'd like to thank John very much for taking part of your Tuesday afternoon to share this opportunity with us. So thank you very much.
It's my pleasure. Thank you, Joy. Thank you, Sarah, for the great work you do.
Thank you, John.
Thank you.
Thanks, John.